When markets are in freefall, the move that feels safest is getting out, even though that's often the move that does the most damage. Now, it sounds counterintuitive, I know, but when you look at what actually happens to investors to stop investing during a crisis, the evidence is pretty uncomfortable. Hi, I'm Brian, and today with MoneyFarm, we're going to look at why you should not stop investing during a crisis. Let's dive in. Crises are nothing new. Wars, economic shocks, and geopolitical upheaval have always been part of the world, and they've always rattled the markets. That's because if there's one thing markets generally can't stand, it's uncertainty. And when a crisis hits, uncertainty is usually all there is. We saw it at the start of the COVID-19 pandemic, where markets went into freefall almost overnight. We saw it after the global financial crisis in 2008. We saw it when Russia invaded Ukraine, and again when Trump's tariff announcements sent shockwaves through global markets in 2025. Different crises, different causes, but the same pattern: shock, volatility, and a sickening drop in investment values. And when you're watching the value of your portfolio fall, it's completely natural to want to do something, like move everything to cash, or sit on the sidelines until the dust settles, as this feels like taking control in a situation where everything feels out of control. The problem is that it's also one of the most expensive instincts an investor can act on. Here's why. When your investments fall in value, you only actually lock in that loss if you sell, and historically, every single time global markets have been through a crisis, they've recovered, and every time volatility occurred and a fall happened, eventually a recovery also happened. That is the pattern. It doesn't guarantee the future will look the same, but it's the most consistent thing we have. But let's say you do step back, you stop investing and wait for calmer waters. What's the real cost of that? Well, here's something that tends to surprise people. The strongest days in the market, the days when prices surge the most, very often happen right in the middle of a crisis. So not after it's resolved or when the headlines are reassuring again, right in the thick of it, when everything still feels uncertain and the temptation to stay on the sidelines is at its peak, which means that if you've pulled out, you miss them. And missing even a small number of those best days can have a dramatic impact on your long-term returns. Here's an example to help illustrate this. This chart shows what happened to $10,000 invested in the S&P 500 between July 2005 and June 2025. 20 years that included the financial crisis, COVID, and plenty of other bumps along the way. Look at that first bar. If you stayed fully invested the entire time through all the ups and downs, your $10,000 would have grown to $66,737. Not bad, right? Now look at the second bar. This is what happens if you miss just 10 best days over those 20 years. Your $10,000 would only be worth $29,690, which is less than half. Miss 20 of the best days, you're down to $17,530, and miss 30 days, $11,445. And if you miss 60 of the best days, which is only 3 days a year, your $10,000 would actually be worth just $4,121, which means that you've actually lost money over 20 years in a market that went up. And here's the thing that makes this even more brutal. 7 of those 10 best days occurred within 2 weeks of the 10 worst days. And the second worst day of 2020, March 12th, when markets were in freefall during COVID, was immediately followed by the second best day of the entire year. So if you were sitting in cash trying to avoid the bad days, you almost certainly missed the best ones too. And in a nutshell, that's the problem with trying to time the market, which is why stopping your investments during a crisis is usually the worst thing you can do. Because you're not just trying to predict one thing, you're trying to predict when to get out and when to get back in. And if you get either one wrong, you'll likely cost yourself decades of returns. So you get the point. Time in the market beats timing the market. Now with hindsight, we can see all this clearly, but at the time, it's almost impossible to spot, which is why people who try to time the market, even professional investors, rarely get it right. On this topic, we've got a whole video on the channel, so if you want to find out more, check it out. So if stopping during a crisis isn't the answer, What should I do? Well, the most important thing is asking yourself one question. Have your long-term goals actually changed? Or are you just reacting to the prices going up and down? Because if you're investing to buy a home in 10 years, or to build a comfortable retirement, or to grow your wealth over time, none of that has changed because of what's happening in the markets right now. The goals are the same, and the timeline is the same. The only thing that's changed is the noise. And when you zoom out, that noise looks very different. For example, if we look at the S&P 500, we can see that it's done a pretty good job of picking itself up and going on to grow even after sharp drops, like in 2008 or in 2020. A short-term chart of almost any major market during a crisis looks alarming, but stretch that same chart out over 10, 15 or 20 years and those same events shrink into blips on an otherwise upward trajectory, and the roller coaster viewed from a distance starts to look a lot more like a climb. And this is precisely why investing is built around the long term. Of course it comes with risk, but if you've kept enough cash aside for shorter term needs and emergencies, you won't be forced to sell at the worst possible moment, and you have time to ride out the volatility. Again, none of this makes the turbulence feel comfortable, but it does put it into perspective. Now, knowing you should stay invested is one thing. Actually doing it when markets are lurching around and the headlines are grim is another. So here are two things that can generally make it easier for you. The first is regular investing. If you're investing on a regular basis, for example through a monthly direct debit, and you keep on doing this through good times and the challenging periods, then you'll benefit from pound cost averaging. To put it simply, if you're putting money in on a fixed schedule, you don't have to make a decision every time markets move, as the money gets invested regardless. And there's a real financial benefit to this, not just a psychological one, because when markets are down and prices are lower, your regular contribution buys more. When markets are up, it buys less. But over time, this smooths out the average price you pay, which means that a falling market isn't purely bad news, but it's also an opportunity. The second is diversification. A well-diversified portfolio spread across different asset classes, sectors and geographies won't be immune to a crisis, but it will typically weather one better than a concentrated portfolio, which means that when some areas are hit hard, others tend to hold up or even perform well. Think back to the start of COVID. Investors with all their money in travel and hospitality took a much bigger hit than those spread across multiple sectors. So this is something you should bear in mind when investing your money. Of course, diversification doesn't eliminate volatility, but it can significantly reduce the impact of any single shock on your portfolio. Now, everything we just talked about, staying invested through the turbulence, contributing regularly, keeping a diversified portfolio, sounds straightforward in theory. But in practice, doing all of it consistently on your own while the headlines are telling you the world is falling apart takes real discipline. And that's exactly where a managed portfolio can make a genuine difference. With MoneyFarm, for example, you don't have to make those calls yourself. Your money is invested in a globally diversified portfolio, built and managed by an investment team and automatically rebalanced when markets move. You choose your level of risk between 7, ranging from cautious to adventurous, and from there, the portfolio does the job it was built for, through the good periods and the difficult ones alike, which means that when a crisis hits and every instinct is telling you to do something, you don't have to, because the discipline is already built in. But regardless of whether you prefer to manage your own investments or hand that responsibility to someone else, the principle is the same. The investors who tend to come out ahead are the ones who stay patient, stay disciplined, and stay invested in the long run. So while it's natural to worry about the impact of markets on your money, and you might have a real desire to stop investing or switch everything into cash, you can see there are some pretty compelling reasons to continue investing during a crisis. Tuning out noise, trying to remain disciplined, and being patient can all stand you in good stead during times like this. So there you have it, all the reasons why you shouldn't stop investing during a crisis. If you found this video useful, please subscribe to the channel. And if you have any questions, drop a comment below. And as always, I look forward to seeing you in the next video. Bye bye for now.